Hello, YouTube. Justin here. In this video, we're going to talk about how after a 4-day historic gain on the S&P 500, we now have the potential to go to S&P 569. Forget about 500. Maybe we're going to go to 569. So in this video, I'm going to talk about my revised base case or my base assumption on where the market's going to go for the next while. We're going to talk about the cycle, meaning the last 2 years in the stock market and what that means for us going forward. We're going to talk about what a bull market of 2022 would look like. We're going to talk about the tech-led rally for this last week. And then we're also going to talk about TINA. There is no alternative. So let's jump straight in and get this show underway. If you're enjoying the video at any time, please smash a thumbs up, drop me a comment, and make sure to subscribe to the channel. So what we have here is a data point which tells us that after 4 strong days like we just saw, they're rare, but they're quite bullish. The reason why is because when we look down over here at the average returns over the next 12 months, it is 28%. So when we go here to the S&P for a closing price of 444.52 on Friday, and we go 444.52 times 1.28, what do we get? We get 568.9856, basically 569. That would be the price we would be at 12 months out from today or on March 19th of 2023. This is very interesting. What's also very interesting is that it goes back to 2022, 1982, 1972, and 1970. And the reason why that's interesting is because here, back to our quarterly chart, what we were talking about is actually exactly this. We have our quarterly chart with a dip in 2018 and 2020. And finally, this week, what we were largely talking about are the best 2-day gains since April of 2020. And then we talked about the best 3-day gain since November of 2020. And the S&P closed out for its best weekly gain since 2020. So this period right here, where we have 2020, seems like it could even be where we go. 28% is the average, which means that we could actually go even higher than 28%. What's also very interesting to me is that we look over here and look at the percent times that it is positive: 1, 3, 6, and 12 months out. 1 month out, we got a 75% chance of being higher. We look at 3 months out, 75%. 6 months out, 100%. 12 months out, 100%. So this is quite bullish if you're not sure. What we're going to do really fast is just go through and talk about the pattern that we saw from the week before. And we can note here that we did actually break our primary downtrend. So charts can do 3 things. They can go up, they can go flat, or they can go down. And on the flip side, they go down, they go flat, they go up. So if we're potentially looking at a trend change here, we're seeing the first evidence by the S&P closing back above the 50 weekly moving average here, engulfing previous candles, but we still got this head and shoulders we got to contemplate with. So I'm going to circle back a little bit later, and we're going to talk about that. So this video is going to be a follow-up to the one from 2 weeks ago, where we talked about maybe the stock market crash of 2022 was canceled. We're going to go through our agenda. Again, these are all the things we're going to talk about. Just note, I'm going to circle back and talk about these a little bit later in the show. I don't want to bore you with the details. Pause the video if you want to read exactly what's here, but this is a preview for what's coming up in the show. I would also note that the timestamps will reflect these. So if you want to jump forward or back to relevant sections, just check the description, which should have those chapters or timestamps laid out for you. Because we already have this fundamental reason for us to be going dramatically higher based on percent gains, there's something else that I'm noticing here, which is the 3 white soldiers. 3 white soldiers is a technical pattern. We're going to read what that means, and then we're going to look at some examples on the chart. And then I'm going to explain what it all means, right, craft it together, and we're going to move forward. So what do 3 white soldiers tell you? The 3 white soldier candlestick pattern suggests a strong change in the market sentiment in terms of the stock, commodity, or pair making up the price action on the chart. When a candle is closing with a small or no shadow, meaning a tail or wick, it suggests that the bulls have managed to keep the price at the top of the range for the session. Basically, the bulls take over the rally all session and close near the high of the day for 3 consecutive sessions. In addition, the pattern may be preceded by other candlestick patterns suggesting a reversal, such as a doji. So what we have here is an example of a candlestick pattern where we see that 3 soldiers. So what's notable here is just that we don't have very many, again, shadows or wicks on the bottom. The real body is the range on the day. And what I'm going to look at now, we're going to be, I'm just going to flip through these pretty fast because there's quite a few of them. Before I forget too, I would also just note that when we look here at our previous all-time high to our back test, we have an extension level here, which gets us to where? Basically 600. So when we made it to 480, that was roughly 90% of the way to 500. And if we get to roughly 569, that'll get us within roughly 5% of 600. So the numbers are very interesting too as we look at the pattern. All right, now we're going to look here at the S&P 500. And just give me 1 second here. All right, so here we have a four. We have a 4 candlestick pattern here, but I'm going to look at notably the last 3 sessions where we look at our template and we see that, right? Small gap down, pump up, small gap down, pump up. We look over here. Oh my goodness, right? Small gap down, pump up, small gap down, pump up. High of the day close, high of the day close, high of the day close, high of the day close. Woof. That's the S&P 500. Let's look at QQQ. What do we got here? Boom, boom, boom. QQQ also has it. XLF. Boom, boom, boom. This one has a little bit more of a tail here, but still three strong soldiers. XLV, right? Boom, 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 boom. 4, right? We got it here too. We look over at what else we got? DIA. 1, 2, 3. There we go. We got it. We can look at Aapl. Boom. 1, 2, 3. A little bit more of tails here, but still technically that same pattern. Where? High of the day, high of the day, high of the day, high of the day. Let's look at Tsla. High of the day, high of the day, high of the day. Gap down, pump up, gap down, pump up. Whoa. Arkk. Perfect pattern, right? Basically green dildos, which means that there's no lower wick, only on the 1 day. What else have we got here? Let's look at Microsoft. And we got tails here, but roughly the same pattern. I'm looking at some of these deeply oversold names like DocuSign as well. Boom, 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 boom. So for me, this is a very bullish pattern just because this is textbook bullishness. When we see this formation, it is textbook bullish. So as we look forward to the later part of the show where we talk about these, we're seeing that if we are actually going to be going into a period where we're going to be getting, again, potentially 28% gains, which would be dramatically new all-time highs, almost 100 points higher, we want to know whether or not there is the evidence to tell us we are actually going to go higher. I would also note that as we look here on SPY, what's very notable is that we got this 50 weekly moving average here, in addition to the 50 daily moving average and the 200 daily moving average right around these same areas. We got them here. You can see over here on the right-hand side, the gray line represents the gray number. The blue line represents the blue number. And the reason why this matters is because when we look here at the weekly chart, if these 3 white soldiers are going to be the catalyst for us to not only hold the 50 MA, but continue to advance, that's the bull break that I literally just mentioned. So if this is going to end up being a failing pattern, we're likely going to close back below the 50 moving average, which should smooth out to roughly 442 for next week. So if you're following along, I know I'm talking fast. It's because there's a lot for us to go through. What I'm trying to say here is that the 50 weekly moving average should act as a push-pull for next week. With the pressure that built up starting on Tuesday and is all the way there until Friday, we could see some continuation going into next week. And if this is going to be a failed pattern, we're likely going to know soon here. However, it's also really important to note that when we look over here at the base case that I was talking about for, again, us almost being over, we're talking about the end of the quarter. So if the month lows are in and we're going to continue to advance, these 3 white soldiers are going to tell us that. We're going to see continuation. And when we get to the later part of the show, when we get through the technicals, I will walk through each of those examples and provide more insight. I'm trying to just tease out so you follow along and know what I want to talk about. All right, so now we're going to talk about the agenda, and we're going to go through here. Again, I'm going to bring this up briefly here, and we're going to touch on the agenda during the bull and bear parts, where we're going to talk about how each one of these agenda items is either bullish or bearish. And same thing with the technicals. I'm going to tell you why it would be bullish, why it would be bearish. So let's go forward now. Looking at the next section here, we got some key dates. And again, as a reminder, we can note that the bigger the text, the more bold it is, the more important it is. This is a Fed week and central bank week. We can note that we got a plethora of Fed speakers. This is very important too. And I'll talk about this a little bit later when we get to the part about talking about monetizing debt. So we got ECB Lagarde speaking on Monday. We got Fed Bostic on Monday. He also spoke last week. We got Jerome Powell speaking at 10 a.m. on Monday. We got Christine Lagarde speaking again on Tuesday. We got Fed Williams speaking on Tuesday. We got Fed Chair Daly speaking on Tuesday. We got Fed Mester talking on Tuesday. We got Fed Daly speaking on Wednesday. We got Fed Chair Powell speaking on Wednesday. We got Fed Waller talking on Thursday. We got Fed Bostic talking on Thursday. Then we got the NATO meeting. This is going to be a very important week because it is central bank driven and geopolitically driven. We also have the end of the quarter coming up on Thursday, the 31st. The base case from before was that the bears were in control. The 400 gap is going to fill. OPEX to quarterly chop. April relief going into the Russia and Ukraine resolution. And then the bulls and bears are going to fight for direction. So what I tried to mention, I believe it was on Thursday, is that we have to know what we need to see to know that we're right, what we have to see to know that we're wrong, and then what we do when we realize we're wrong to revise our base case. And that's what I'm doing here. I'm revising my base case because what I thought was going to happen didn't materialize. I knew I was wrong on Thursday. As we go forward to here, now I'm going to provide you with my new base case. So again, here you can note that it says revised. So what we're going to talk about is going to be TINA. There is no alternative. And we got two important data points this week, which confirm that. We got the Russian US dollar bond payment, which meant that they were talking about paying in rubles, but they knew that they kind of got cornered and they paid in US dollars, basically confirming that there is no alternative to the US dollar, at least for right now. And then we also note that we had Chinese support for dual listing stocks, and they would only do that because they have to. This is not something they want to do. It's something they had to do. And we'll circle back and talk more about this when we get to the bull thesis in the video. I believe we're going to test up to 454.05. And that 454.05 is the neckline on our head and shoulders pattern here, which is at exactly 454.05, which goes back to our August 30th weekly high. After that, the bulls or bears are going to fight for direction. I'm giving the bulls the edge just because I'm seeing a lot of my indicators, a lot of what I look for telling me that it's up time. But we need the confirmation. So I believe we're going to do something like this. Hit the 50 MA, back off to test the 50 average, and then advance. How high do we go after that advance? I don't know. But again, I am giving you my best guess in terms of what I can see happening the next week. This right here is a massive candle. It closed at the high of the week. There's more pressure building up. It's likely going to release into next week. How high do we go? Depends what happens. And it depends on a lot of those key dates we talked about, notably Thursday. If there's a resolution in Europe on Thursday, oh my goodness, is that going to be super bullish? Why? All the Fed speakers are out of the way, and then we can focus on global peace, especially after we saw that President Xi and President Biden spoke on Friday before Joe Biden flies out to Europe to have a NATO meeting. Going forward to section 4 now, OPEX and quarterly chop. I'm not going to talk about options in this video because, frankly, they're pretty boring. There's not a whole lot going on, which means that no one is really particularly motivated to position one way or the other. So there's the existing options. We got 451, 452. Again, that's the SPX put spread for the quarterly expiry. But other than that, I'm going to ignore it for this week because it's not as important. I also still believe that into early April, we're going to find out whether or not we're going to get relief. So let me tie this all together and give you my best assumption here. So when we look back to what could happen here, we note that we got the test up to 454. We got OPEX and quarterly chop, and then we got April relief. So what I'm going to attempt to do here is to tell you what I think is going to happen. Please note, I'm not Nostradamus. I can't predict the future, but I can make my best guess. That's what I'm doing here. I'm guessing. So like I mentioned, I think that we're going to go up. That would be for next week, and that ends on the 25th. And then if we look to the calendar, we got Thursday, the 31st for the last calendar day of the month, which means 1 week, 2 weeks, and then the start of the new month into Friday. The reason why that matters is because we can push off, we can backtest the 50 average, and that would be closing out the quarterly charge. So into the Friday, we have S&P opening up this new candle. Again, our quarterly chart here, what that would tell me is that our two previous patterns back to 2018 and back to 2020, if we do actually push back down and close below where we are right now, that would mean that we are set up for a gap down pump up. What would cause that? I don't know, but it's 2 for 2. And when we look back to the crash of 2020, again, that is being summarized here by, again, being the strongest, most violent 12-month gain ever after 4 consecutive green days. So I'm thinking that, again, go higher a little bit, come back down somewhere, and that gives us more room to not leave a lower wick, basically giving us the start of a new rally, which might be substantial. All right. That's the easiest way for me to explain it. I'm going to save that other part for later. It's already been 15 minutes, so I'm going to try to go through a little bit faster now because, frankly, there is a lot for us to talk about. All right, so I talked about how this might be already over, and I'm going to likely leave it there because there's a lot more for us to go through. Why are we bullish and why are we bearish? So here is the base case that we've been talking about for a while. You're going to note there's been nothing notably different because we still have to wait for more data to know whether or not this is going to change. And week by week, we are getting a lot of kangaroo action, which means that we're going up, we're going down, we're going all around. So why bullish? Well, because the monthly bottom is in. And as we have a look here, the monthly bottom is holding. And on the monthly chart, here we can just note that, again, low, higher low. But here we got a lower high. That's an inside bar. And it's a hammer. And we got 4 months of dip buying. What does that mean? If they were willing to buy the dip here back in December, willing to buy the dip in January, willing to buy it in February, willing to buy it in March. Is that enough dip buying already? I think so. Why? The 3 white soldiers are like, man, we've been buying forever. We've been buying for 4 months. Of course we want it higher. Screw these bears. Let's burn them. And that's what I see happening here. 4 months of dip buying. They're finally regaining control of the chart. It's go time. If these bulls are in control, they have to march. They got to get us over the 200 DMA, and we got to start mooning. Let's go. Peak hawk and geopolitics. I'm going to talk about this a little bit later, like in a moment or two. But again, I think that the easiest way to summarize this is that who did not already know that Jerome Powell was going to raise interest rates on Wednesday? And the market priced it in perfectly for 7 rate hikes. And when we got what was expected, what happened? Relief. Because who was left to short going into the meeting who was not already given the information? Everyone knew. Everyone knew about it. There was no one left to short it. What does that mean? If bad news can't take us down, what can good news do? Up. And then we got the surprise from China, and then we got some resolution in Europe. Things are looking pretty good. And in terms of what else, the way I would summarize this is that when I laid out my bear market of 2022, I was bearish just on the fundamentals. And there was if we would have had a reversal like we saw this week, I would have still been worried about that black swan event. Again, Evergrande was potentially going to be one of those. We got what happened in Europe. And now I think that because we got the war in Europe at the same time as we saw the hawkishness from the Fed, what that tells me is that the market's been tested repeatedly. We heard the hawkish narrative come out starting in January. It repeated through to February. And then in March, we got a big surprise. And because the bears and bulls have both had a chance to try to take control of the chart, and the bulls were winning with 4 months of dip buying, I don't know what else could drag us down. And when we look at that history of 20% higher after 1 year, I could see that happening because even if there's a big nasty surprise which happens, we already got a shock like we've not seen in decades. So I literally do not know what else we could get in terms of us going lower. For the bear thesis here, again, this means that the wheels are still in motion. We are at the peak cycle, and then the inflation narrative is not going anywhere. Everyone now knows inflation is real. On the flip side, the things that could surprise us this week would be the Fed speakers, geopolitics, notably the result of the NATO meeting on Thursday, and that's what I'm watching for. All right. So everyone talks about printer go burr, but why? And why did Jerome not really do very much to actually temper inflation? I think there's a very easy way for us to understand this. And I'm going to come back to this in a moment here, but let's have a look at a couple things here. So let's just think about this. When you look at these numbers, they are ultra scary. The U.S. national debt is $30 trillion. The debt per citizen is $91,000. The debt per taxpayer, $241,000. And then we look over here at, again, even in the current environment of basically zero interest. Again, US total interest paid, 3.3 trillion. Interest per citizen, 13,000. And then we look over here at the savings. They got 14,000. Debt per taxpayer, 69,000. We look at student loan debt, 1.8 trillion. Credit card debt, 1 trillion. Do you understand what I'm trying to lay out here? Jerome Powell is going burr because people are broke. And debt monetization is something very simple. Let's read the definition and see if we understand what this means. Debt monetization, or monetary financing, is the practice of government borrowing from the central bank to finance public spending instead of selling bonds to private investors and raising taxes. The central banks who bought government debt are essentially creating new money in the process of doing so. This practice is often informally and pejoratively, I think I said that right, called printing money, which everyone knows, right? Burr, right? Printer go burr. That's debt monetization. It is prohibited in many countries because it is considered dangerous due to the risk of creating runaway inflation. To prevent inflation getting out of hand, central banks often keep a close eye on CPI as to not create too much new money. During the lockdown, central bank policies in response to the emergency, such as quantitative easing, are considered to be very similar to debt monetization, although with subtle and important nuances. Oh man, that seems pretty interesting. So when we go back to here, these are really big numbers. And again, is this ever going to get repaid? I don't know how. This does not even include state debt, local debt, unfunded liabilities like Social Security, like Medicare, Medicaid. It doesn't include any of that. Liability per citizen is $500,000. So we got $500,000 in liabilities per citizen. We got $241,000 in debt per taxpayer. And we got personal debt over here, roughly $70,000. How the hell is this ever going to get repaid? And I say that because before the bad word happened, just 39% of Americans could afford to pay $1,000 emergency expense. So what does that tell you? It tells you that there is no effing way that if people can't afford $1,000 emergency expense, and I'm talking basically half the population, how are they going to pay back 91,000, 241,000, 69,000, or $500,000? They're not going to. So I think what's happening here is that Jerome is monetizing the debt. And by monetizing the debt, all that means is that he's making today's debt worth less tomorrow. So if we think about what that means, it means that, again, let's pretend that we're thinking like Jerome Powell. Why have they been buying mortgage-backed securities? They've been buying mortgage-backed securities because they want to keep mortgages stable. And if the average person or average American owns a home, and now let's pretend, again, thinking back to 2018, if the property value, again, a lot of people are going to put down between 5 and 20% for their down payment. I know that my personal property has gone up almost 100% in the last 5 years. And in the last couple of years, with all this inflation, everything's been skyrocketing. So if you've been buying into the market in the last couple of years, you're buying at a very inflated price, which means your 5% down payment, if we have a 5% correction in the housing market, by the way, the stock market went down by 15%, you're wiped out. You got no more equity left. And now you're underwater, which means that now that creates a big burden, which is the reason why I believe the Fed has been monetizing the debt and buying those mortgage-backed securities, because the average American is going to really feel that pinch. The second thing is that they also have to try to control, again, inflation expectations, because bonds drive based on that. If we're not going to get any payment in bonds, what's the point in holding on to them? Again, real inflation at 7, getting 2%, you're losing 5 guaranteed. So that's what's really interesting here, is that there's a very fine balance between everything we've talked about. So I don't think Jerome Powell is going to explicitly tell you that, but that's what I believe is happening right now. I believe that another way to try to explain this is that Ray Dalio talks about the big cycle. And what I am noticing is that when you're fighting, again, a military war around the world, and we saw with SWIFT potentially getting removed from Russia and from China, there was the potential for the US to lose some of its financial superpower. However, when your country is doing well, your people are rich, they're more likely going to want to support you when you're going abroad. What does that mean? I'm going to quote Mason here. I'm going to say that, again, a stable stock market and a stable markets in general is basically a national security risk. And what I've been talking about is basically hearing Jerome Powell talk about a third mandate: price stability, full employment, and market stability. Stock market, equity market, all of that, housing market. That's what I believe we're hearing from the Fed. And I don't think they're going to tell you that. So if we look back to what I talked about here, and we think about all the borrowing the government has done, I'm going to use a very simple example here. I am going to talk about something that's I think most people will probably appreciate. Let's talk about chocolate bars. So when I was a kid, again, let's just think about this. I'm a kid. I'm 33. So when I was a kid, like about 20 years ago, chocolate bars were about 90 cents, 99 cents each, $1. So again, I'm in Canada, about $1 for a chocolate bar. Today, they're about $2. What does that mean? $1 that I would have had about 20 years ago is worth about 50 cents on the dollar today. My buying power has been reduced by half. But now let's pretend we use that same one number there. Instead of buying something, I'm going to borrow 1,000, 1 million, 1 billion, 1 trillion. And if in 5, 10, 20 years from now, the buying power is half, what does that mean? Technically speaking, in buying power, I owe half. So when we look at these numbers here, and we know that the average, again, the national debt is 30 trillion. The debt per citizen is 241,000. We look at the personal debt per citizen at 68. We look at the unfunded liabilities at 500,000. What we can do is make these numbers worth half, if not less, in the future. By what? Printing money, debt monetization. That's what I believe is happening. The easiest way for me to simplify that. And we're in the agenda, we do have a section where we're going to go and talk about how to invest in an inflationary environment. So now I'm going to talk about each one of these fundamental things, and we're going to try to understand what it means for us. So the camera might be cutting out too. I honestly don't know why it's been doing it. If it has, I'm sorry, right? Maybe I got a potato camera, but anyways, looking to here. I'm gonna read these off, and then I'm gonna go through them one by one. So top one here is the cycle in the last 2 years. We've already talked about monetizing debt. We've talked about the base case being updated. Geopolitical tension, I'll touch on that in a moment. Federal Reserve speakers, we'll get through that. Yield curve inversion, but the Fed owns 25% of the market, so maybe it's not as predictable as it was before. TINA. Then we're going to talk about how to invest in an inflationary environment. So as we go through and look at each one of these things, I think what's important to note, and then the China put too, I think what's important for us to note here is just that as we look through to this cycle in the last 2 years, I was not financially or market savvy enough during 2008 for me to actually understand what "don't fight the Fed" means. I was also not inept enough, or again, sophisticated enough to know how to trade it. Now that we have gone through a normal period in 2018 to 2020, the going to zero, again, it's the fastest recession ever. We had the recovery, we had interest rates going to zero, quantitative easing, and now we're going back to trying to normalize. So in roughly the last 2 years, you've gone through a full cycle. Normally, these take decades to fulfill. And what that means is that you now have not only the experience, but the understanding of how to trade these in the future. So for me personally, again, what you feel or your emotions are different than what should be happening. We talked about that last week. So the cycle here just means that I want to talk about one thing here from, again, this is Mike Mernovini. I'm going to quote him because he's smarter than me. So with the yield curve close to inverting and high inflation being met with potentially the most aggressive Fed we have seen in years, many are wondering, can the market rally? Historically, it takes a number of rate hikes to cause a recession and materially affect the stock market. Looking back to 1950s, 1990s, 2000s, and 2016 here. What do we get? Well, the Federal Reserve raises interest rates by 500 basis points or 5%. What happens? Stock market goes up by 30%. We'll look at what happened in 1992. Interest rates go up by 500 basis points. Stock market goes up by 58%. In 2004, interest rates go up by 455 basis points. What happens? Stock market goes up by 46. In 2016, we have 239 basis points increase in the Fed funds rate. And then we got a 43% increase in the market. That makes a lot of sense when we look at that and we compare it to the average returns that are seen after a 4 days like we just saw. So hopefully you are following along. And what this tells me is that Again, those who don't understand history are doomed to repeat it. If you did not understand what happened in March and April of 2020, what happened in November of 2020, this is telling you it's time to go up. If everything starts to self-fulfill, we're probably going to go higher. Still need more evidence, but the way that the market actually buckles is that the Fed takes it to a point where they think that we just want one more. We just want one more hike. We just want to do one more. And when they do that, one extra one, that's when it breaks the system. The reason it breaks the system is because right now, I think I'm actually going to flip forward to another section here, then I'll come back and try to explain this. So we're going to jump forward to here, and we're going to talk about how to invest in an inflationary environment. So now we're going to go to someone who's even smarter than me, this guy, Warren Buffett. And Berkshire Hathaway hit a fresh record high of 500,000. Blue sky breakout. Easier to go up than to go down. How did he do it? He understands. He's old. He's got a lot of experience, a lot of wisdom. And he's going to tell us the top tips for beating inflation. How to beat inflation, according to Warren Buffett. Number one, invest in good companies with low capital needs, basically tech companies. Look for companies that can raise prices during periods of higher inflation. Productivity growth. Yep. Look at TIPS. TIPS are Treasury Inflation Protection Securities, which basically, again, the TIPS pay investors a fixed interest rate twice a year, but the principal amount is adjusted for inflation as measured by CPI, which means that if you're worried about inflation, buying a TIPS is going to mean that you're going to get basically a perfect offset for what inflation really is, not what the 10-year note yields, but what CPI actually is. Number four, invest in yourself and be the best of what you can do. Oh, man, that seems really interesting. And then the last thing here is going to be steer clear of traditional bonds. So this is basically what we've been talking about. And then number six here, limit your wants. Again, wants versus needs. So what I think the most important thing for us to understand here from Warren Buffett is just that the best way to beat inflation is by owning stocks. Why? Because stocks are representations of companies. Companies are able to pass on their costs to consumers, and the strongest companies are going to be able to do that best. So if you're worried about inflation, if you're worried about anything, there's three places your money can go, as we talked about in the bear market of 2022 explained. Your money can sit in cash, it can go into bonds, or it can go into the market, into equities. So if cash is trash and if you don't do anything, you're going to lose basically 7% because that's what inflation is. If you buy a bond today, you're going to be given 2% for a 10-year note, and inflation is actually closer to about 2.5%, something like that. Inflation is closer to 6 or 7%. You're guaranteed to lose on that too. Just lose a little bit less than cash. However, if everything is being inflated and we're monetizing debt, what should happen to the stock market? It should go higher. Why? Stocks are valued based on price to earnings. So if their price has been going down and their earnings is going to be going up because they're passing on cost to consumers, like Netflix going from $7.99 to $8.99 to $13.99. Oh, did you cancel your Netflix? I haven't. A couple extra bucks is not going to get me to cancel. So these companies are going to produce more earnings and by result, higher share prices. That's what's going to happen. So one of the best ways to fight inflation is to be in the market. Cool. All right. Now we're going to talk about the geopolitical tension. So the geopolitical tension is largely coming to a close because we saw that after a readout here from, Joe Biden, who was the president of the United States, talking with President Xi Jinping, who was the president of China. I'm going to read this, and I'm realizing the video is probably going to be a little bit longer. I'm sorry. I'm doing my best here. But again, if things are changing, we got to do what's needed. I'm going to go through and read this now. Again, President Joe Biden spoke with President Xi on the people, blah, blah, blah. The conversation focused on Russia's unprovoked invasion of Ukraine. President Biden outlined the view of the United States and our allies and partners on the crisis. President Biden detailed our efforts to prevent and then respond to the invasion, including by imposing costs on Russia. He described the implications and consequences of China provides material support to Russia as it conducts brutal attacks against Ukrainian cities and civilians. The president underscored his support for a diplomatic resolution to the crisis. The two leaders also agreed on the importance of maintaining open lines of communication to manage the competition between our two countries. The president reiterated that U.S. policy on Taiwan has not changed and emphasized the United States continues to oppose any unilateral change to the status quo. The two leaders tasked their teams to follow up on today's conversation in the critical period ahead. And the reason this matters is because we're going to be getting a NATO meeting after. So what's happening here is that they're priming the pump. Before Joe Biden goes and starts trying to take another piece out of Russia, he wants to make sure that President Xi understands the consequences if he goes against them. So again, I have convened an extraordinary summit on 24th of March at NATO HQ. We will address Russia's invasion of the Ukraine, our strong support for Ukraine, and further strengthening NATO's deterrence and defense. At this critical time, North America and Europe must continue to stand together. So what this means to me is that the geopolitical tension as of right now appears to be ratcheting down. Zelensky is also calling for direct conversations with Russia. And I think both sides already know what they're going to concede on, what they're going to keep. So as of right now, in my opinion, I am seeing a lot of evidence that the geopolitical tension is actually going to ratchet down, and we're likely going into a period that is more normal. Next thing we're going to talk about here is going to be, actually, I'll talk about the Federal Reserve speakers when we get to the bear market part. Yield curve inversion. So actually, I'm going to leave that part till later too. Tina, I'll get to that in a moment. The last thing I want to talk about here is going to be the China put. So we just finished talking about China. Let's go back to here. And actually, I'll show you the other article here too. Actually, I don't have to show that. That's fine. I'll skip it. Look into here. China put can be game changer for stock market after global rout. Stimulus loosening vows may give China stocks haven status. Again, when the week started, JP Morgan Chase analysts warned that Chinese internet stocks were uninvestable. The world is in a different place now. Why? Because they've come out and they've supported everything. They've allowed dual listings. The market was indeed oversold, irrational in the dramatic rout. So the real money is back doing bottom fishing. So all this tells me is that there's a long road to recovery, right? The Golden Dragon Index had a record one-day gain. I think it was 33%. And basically, the easiest way to summarize it is back to here, the Draghi moment. The announcements amount to a Draghi moment, Shanti, blah, 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 said on Bloomberg TV, referring to the former president of the European Central Bank, who's pledged to do whatever it takes to save the euro area turned the fortunes of the currency bloc during the sovereign debt crisis a decade ago. And the reason why this is particularly interesting is because, right, jumped 33% in one day. I don't know if I'm going to find it exactly in here, but Xi Jinping right now is trying to go for an unprecedented lifetime term in China, which means he needs his people happy, content for him to get that lifelong presidency in China, like what we currently see what's happening with Putin. So going back to here and trying to finish off the story in terms of the geopolitical tension. So again, I'm not a political strategist. I'm not a military strategist. I'm not Nostradamus, but I have a brain and I'm able to use it. So what that tells me is that up until going into the Olympics, President Xi was really buddy-buddy with Russia. They had a joint statement. They were standing back-to-back against the West. And the West looked pretty bad because we have a new German chancellor in Germany, right? The most important country in Europe. We have a French election coming up in the spring. We had a riot happening in Canada, occupying the capital. Joe Biden's got a lowest level of presidential approval. So I believe that Russia thought they could go and capture Kiev in a couple of days, and the West would not have time to impose anything on them. And President Xi provided himself some optionality by not taking one side or the other. But here we are, almost 4 weeks later, and Putin hasn't won. So I think President Xi wanted to back a winner. Putin does not look like a winner right now. So what does that mean? He's had to step back. He's had to reevaluate. And as they are both currently, again, basically in lifetime terms, if they really want to be coordinated to come back and do anything, this was their chance. And they fumbled massively. And then also when we saw the Russian bonds being repaid back in US dollars, and then that dual listing happening on Wednesday, 2 days before the call with Joe Biden, they lost. Right? They lost. The West is the best. That's all we know. West is best. So as of right now, they've started to concede. As we move forward to here, which is going to wrap up the story, Tina, there is no alternative to these asset classes in terms of America. US dollar is still king. We saw that pretty evidently when we heard about the SWIFT payment system potentially getting removed from Russia. And then we were hearing that, oh, well, what happens if Saudi Arabia starts pricing their oil in yen? What happens if China starts offering debt to Russia? What happens, blah, blah, blah? What if China has their own SWIFT payment system? They don't. No one does. The US is still king. So in terms of the US dollar as reserve currency, there is no question, there is no alternative, period. We look at the stock market. Again, out of all the companies you use, the most important ones, how many are American? For me, it's like 90+%. And the companies that have the highest pricing power and productivity growth are SaaSes, software as a service, because for every extra dollar in revenue, it generally does not require more people. Think about this. You sign up. So Netflix has a fixed overhead. They got so many staff in their offices. Now, for every extra person that starts paying for Netflix, do they have to hire more staff? Not really. They just make more money per user. So for a software company, higher prices are good. If you're selling a physical good, what you have to pay for inventory costs. You have to pay more. And if you sell more units, you make the same margin. Volume discounting actually starts to hurt you. So that's the very big difference here. And in terms of countries, America produces a lot of software, a lot of SaaSes. And China produces a lot of, again, they're a sweatshop. They produce a lot of physical goods. Which one's better? You tell me. In addition to that, the next phase of the global market expanding, I think, is going to be in regards to crypto. So what China's done and what Russia's done, because they don't have a strong currency, they are scared. People are going to sell their local currency and hold on to Bitcoin, hold on to Ethereum, or whatever. So what do? They banned it. They banned innovation. What did they do to Ant Financial, which was Jack Ma's potentially going to be one of the biggest companies ever? They shut it down. They put him in jail for months. What does that mean? They're not bullish on innovation. So in terms of the stock market, in terms of innovation for the future, again, the West is still best. Pricing power. If China can no longer produce the cheapest stuff, other countries will step and do it. They can't get things on ships. Maybe Mexico starts building them, right? We have no idea. But if Netflix goes up by $1, are people going to cancel? Probably not. If Apple's device goes up by $50 for the iPhone, are you going to start using something different? Probably not. If your Office 365 is now going to cost you $1 more per year or $2 more per year, which Microsoft just raised prices on for the first time in a while, are you going to cancel? Probably not. You got better pricing power. Military. The US military complex is still the best in the world. And in terms of politics, like I mentioned briefly before, I believe the East thought that the West was fractured, the West was weak, and they came back swift and strong. There were these sanctions, there was the retaliation that happened almost immediately, and they were united. So there is no alternative as of right now. So our market thesis in terms of, are we going to go higher? Everything says yes. We listen to Warren Buffett, again, one of the richest guys on the planet. He tells us basically buy stocks. And Jerome Powell is monetizing the debt. Why? It's unaffordable. So everything right now is telling me that it is time go up. Next thing I want to look at here is going to be the Fed's hawkishness and dovishness and hawkishness going into the meeting. People were surveyed and asked, what could go wrong? 23% said the Fed will be too loose, will be too slow. 20% said they'll be too aggressive. 49% they're equal risks. So when we look forward to that, what I'm going to do now is go forward here to the next section, and it's just before the bear market. So I'll just go through this here. We have a meeting coming up on May 3 and 4. You can note here there is no asterisk, which means that there is not going to be a summary of economic projections. However, what is really important here is that Jerome Powell basically said that we are looking to begin balance sheet runoff in the May meeting. So what it means is that we're not going to get a summary of economic projections, and the summary of economic projections are as follows. So we look back over to here, right? GDP, unemployment, inflation, the Fed funds rate. So this is basically the softest landing ever in a rate cycle. People are calling this Alice in Wonderland, right? They're calling it wishful thinking. They're calling it hope. Whether or not this is true, again, talking about everything we mentioned before, there is no alternative. What are you going to do? Tell Jerome Powell he's wrong? We're going to have to see the data. And what Jerome Powell said specifically is listen to the Fed minutes, which are going to get released later. If you remember, when we actually took a massive leg down was when we saw the Fed meeting minutes from December, where we saw the telltale sign we were going to be going lower. So the the December minutes, which were released in June. So now let's try to find out exactly what the Fed is telling us. So there is a plethora of Fed speakers this week. How many? Oh my goodness, right? Who is not talking this week? Look at this, right? We got, who do we got here, right? We got Bostic. And we heard from, I think what's actually important for me to note here is just that we heard from Waller, we heard from Bullard, and we heard from Bostic on Friday. And in terms of where those Fed speakers lay, again, over here we got Waller and Bullard, who are the most hawkish. They both vote in 2022, which means their opinions matter. And then we also heard from Bostic, who is not a voting member, but he's still on the team. So he's hawkish, right? He's over here. And all three of those guys basically said, we got to run the balance sheet off double the amount from last time. So what I'm trying to point out here is that when we look at the dot plot here tells us that we're looking at a few things here. So the first thing is that we got a green line. The green line is going to be the median. The median meaning how many dots are above, how many dots are below. It is not the average. Then we look at the white line. That's the Fed funds future rate. And then we look at the individual dots, which are going to be yellow. And that tells us that there is a very, very, very wide discrepancy. Some people believe we should be above 3% by the end of this year. Some people believe we should be below 1.5% by the end of the year. So what does that mean? It means there's a huge range of opinions on the Fed. I think we all know who this person here at 3% is. It's James Bullard. He basically said this week that we should be above 3%. So what's interesting here is that the median accounts for, again, half the dots above, half the dots below. So as we hear from all of these Fed speakers this week, what I will be looking for are going to be clues in terms of whether or not they are shifting from being hawkish to dovish or dovish to hawkish. And we're going to be hearing from very many of these speakers. The person I'll be paying attention to after Jerome Powell will be Fed Chair Williams, because he is part of the Troika. And the Troika is Fed Chair Powell, Vice Chair Brainerd, and Fed Williams. That's the Troika, the three most important people at the Fed. So if we start hearing rhetoric from Williams for going from dovish to more hawkish, that might be a telltale sign for what we're going to get going into the meeting minutes from March, which will get released in April. And if anything that Jerome Powell says that is different from last week, I'll also be paying particular attention to. So if you understand what this means now, all I'm trying to say is that the potential for the Fed is very high. And as we look forward to, I think that's everything. So I think that's everything in terms of the Fed. So now we're going to move forward. Now we're going to move forward to the bear part here. So let me actually just get over to here. There we go, bear market. So now we're going to go through the bear thesis here. And so why would we be bearish? Well, the wheels are in motion. We got the peak cycle and we got the inflation narrative. There's holes in this theory now. There's holes in here. So again, doesn't mean the bulls have won. It means they're winning as of right now. So when we think about what could be bearish in terms of the fundamentals here, well, yield curve inversion. So the yield curve is going to invert at some point. However, the Fed has had their fat finger on the scale for years. Why? They own 25% of the market. So it's distorted. And we don't know whether or not yield curve inversion is still as accurate as it's been before. Period. How to invest in an inflationary environment? Well, some people are scared. They're gonna raise cash. So there we go. We also have Goldman Sachs telling us that the risk of recession is high at 35%. What are they quoting here? The slope of the yield curve. Again, what I think they're not fully appreciating is that the Fed is in there. They're buying. They've been buying for years. They got 25% on their balance sheet. They own 25% of those bonds. So is the slope of the yield curve still as accurate at predicting recession as it has been before? I don't think so. In terms of what could actually be bearish, here's a headline that I think might actually come to fruition again from Goldman Sachs. So Goldman Sachs says market now too relaxed on Ukraine risk. Pricing makes asset vulnerable to deterioration. Stoxx 600 has almost erased losses since Russia's invasion. So if the talks that happen on, I have it here. 1 second. So Joe Biden is going to be traveling to Europe next week for talks with NATO allies. If this does not materialize in anything positive, that is how we could see the bear case setting up here. So that's how I could see this fulfilling here, the bear potential. Also, we can note here and just look at the balance sheet runoff. So I think that it's hard for us to predict exactly how this is going to happen. And we have to wait until we hear the Fed meeting minutes and see that May meeting to know for sure how fast they're going to run off. Because as of right now, we're getting a $1 trillion run rate in terms of balance sheet runoff, which would be twice as aggressive as last time. So that is where we might get a chink in the potential for us to actually go up by 20%. Maybe it ends up being less, or maybe we make history by going red in every period. That would be a first. So I don't think that's the base case. Also, we've not even tested the 400 gap. But as of right now, the 3 white soldiers, if accurate, got us to the 50 weekly moving average, and now we're above it. We should not be going down to the 400 gap. If we do, we're bearish. We're trending back down. Head and shoulders is valid, and we're going to go lower. And this right here is still our bearish potential. So we can invalidate this by what? Going to new all-time highs. That's how we get over the bear market potential here. So now I got a couple more things to go through, and let's see where I want to lead off from here. So let me just see if I got anything else on here which is actually important for us to go through. No. Here we go. So now I'm going to look at the here's a good way for me to summarize what I am looking for in terms of the potential for us to go up or go down. We showed you this BTC versus ES template last week, and now we have an update. We basically completed the pattern, and now we're starting to deviate from it. What that tells me is that the green line right here, again, was an excellent predictor of we were going to go up on BTC. It dragged the S&P up about 2 months later. 3 consecutive tops, 4 consecutive bottoms that are higher. There's the drop. There's the other drop. And here we are. We're all the way back up here to the pink line. So if we're going to repeat the BTC pattern here, all we have to look at is that we're not going to advance over the pink line. We stall out and go back down. That would mean that our weekly chart for the S&P is going to reject off the 50 weekly and go back down, probably closer to the green line in the 420 area. However, we can note that we actually closed over the 50, we touched the 200, and we're starting to deviate from here. So what I think is more accurate for us going forward is to say that this is close enough. If we're going to start to actually trend back up here, this pattern is likely complete. It was an excellent predictor for about the last 5 months. And going forward from here, we're now going to form a new pattern. So if we're going to go back down, it tells us that it should happen immediately. We should fall back below the 50 and put in a lower high, a higher low, but that'll happen in a month or two. So that would be the May monthly meeting where we have the Fed telling us that they're going to do the balance sheet runoff. Additionally, if we're going to hear from Jerome on Monday that he actually thinks the market is too high, why? Well, we heard from the 2 most hawkish members on Friday, and the market no go down. It went up. So if Jerome wants the market down, he is going to echo what Waller and Bullard have already said. Balance sheet has to run off faster. We got to go more, not less. So that's what I'm looking at for the potential for us to go down. And again, whether or not we get resolution in Europe. So that's the potential for us to go down. I'm leaning on we're going to break higher. We're going to go up. So there's the bearish potential, number 1. And then if we go back here to our template, let's just go back here. Right? I forgot I got a few things on here. Technicals. So let's look over the technicals now, and let's look at the heat map. So what I want to look at here is notably what happened in the last 1 week, because it is bright green everywhere. There is breadth, there is depth, and we can note that the only pocket which is red is energy. So we're undoing or reversing a lot of what happened year to date. So if we're going to be going to a new reversal here, looking at year to date, we're seeing an exact opposite of energy being bright green, everything else being a little bit red. And then again, looking at the last 1 week here, this is perfect rotation. What's working is everything that wasn't working so far year to date. And what was working is no longer working. Oh, so those 3 white soldiers and this with everything else tells us that this looks pretty damn bullish. Yeah, it does. Look here at the fear and greed index too. And a year ago, we were neutral. A month ago, we were fearful. A week ago, extreme fear. Previous close, fear. So markets bottom on fear. Here we are. We're ratcheting back up to fear. We're out of extreme fear. We were all the way down to about 13, 14. Now we're back up at 37. There's tons of room for us to go back to greed. And there's tons of cash on the sidelines. Cool. 3 white soldiers, we talked about that. They're pretty much everywhere. Now we're going to look at ETFs. We're going to look at the $1 trillion companies, and then we're going to touch on SPY. Looking here, I'm going to spend a few extra. Actually, I'll talk about QQQ last. I'll talk about it a little bit more. Here we got XLF, so financials. We can note that they're pretty much butting up here right against the 39 area, which is very important. Getting back above there, we got a breakout over the 50 MA, really important. XLV powered up massively. We got a head and shoulders pattern here. Same thing as XLF, a couple cents higher. We invalidate this pattern. Massive week, 6%. Now we can look at something like DIA. Now, not quite at the 50 MA, but massive week. And it's showing some reversal signs here. Volume is all green. It looks good. And let me just make sure I got my rhetoric and stuff prepared here. 1 second here. All right, sorry, I just got one more thing I want to go through here. So let's look at Arkk. Arkk as well. So the riskiest asset is up 18% on the week. That is huge. And we talked about those inflows that came in last week. It's right back at the green line. It's off by a couple cents. So same thing as the previous charts, a couple more cents higher, and we're looking for continuation. Other things we want to look at here are going to include the Russell. So the Russell actually stopped going down. So now it can what? Maybe go back up. NYSE back at the 50 MA, off by about, I think it was $6. We look at equal weight S&P, boom, over the 50. What else have we got here? That's all that really matters. VIX like breaking down, so that's really bullish too. And gold cratered, right? We're still bullish here. We still got a bullish pattern, but right, massive cup. IHS is still holding, but way off the highs, right? Double topped and then rejected here, off by about $150. So in the meantime, Bitcoin has been going back up. So the risky assets are starting to show some signs they want to go up. Doesn't that tell us that if we're getting a tech-led rally, that's a healthy market? That's all we'll always talk about. Chips lead tech, tech lead SPY. And for the last 1 week, NVIDIA is up 20%. Tesla's up 13. Amazon's up 10. Whoa, those are the biggest gainers. Yeah, they're the biggest gainers. Chips lead tech, tech lead SPY. Look over here. This is the tech sector. So look at that candle, 8%. Oh my goodness. Before we look at that, let's look at the monthly. So here we're literally only a couple cents off. Actually, I think we might even be above it. 350. 350.32, and then over here we got 352. So we've already cleared the low going back to October. Getting back over 352 clears that previous low, and then we got room to get up here. It also looks very similar to the S&P where we got 1, 2, 3, 4 months of dip buying. No upper wicks, only lower wicks, which means it sells off, gets bought up, sells off, gets bought up, sells off, gets bought up. Interesting. Looking at the weekly chart, we blew through this funnel lower here, right? We're dramatically higher. We got a lower low and a higher high. So we got a full bullish engulfing candle. It engulfed the whole previous bar and previous bars up. We got to get to the 50 MA, but this is dramatic progress, and there's even room for us to back off and test 334 if needed. Looking at the daily chart, right here on the 50 MA, it's rocked. So took the funnel, got right down to the bottom part of the channel, actually printed a lower low, trapped the bears, and lifted off. We got 4 white soldiers here. Incredible. So right now, the QQQ is off the lows the most. So what that tells me is that growth is back in play. And we talked about pricing power. And let's actually look at the tech sector first here. So in terms of companies that were the leaders of yesterday, and I think are still the leaders of tomorrow, it's a $1 trillion company. And again, are you going to stop buying an iPhone because it's $50 more? Probably not. The chart tells us that too. Still over the 50, huge move off, micro lower high over 166. It would do a new bull break. So as we look forward to a lot of these charts, they only need a little bit higher, just like all the major ETFs, to get up there. So if we're looking for continuation into early next week, all of these basically say, I'm ready to go. Amazon here could be forming a massive W for us to get back to all-time highs. And if we can get over the 50 MA, we're likely going to get there. This red line has been very tough ever since our last sprint from 2020 all the way up to the high at roughly 32.50. Looking at Microsoft, which again, we know it has price. Why? It raised prices for 0365 in the first time in, I believe, about 10 years. It's ready for a bull break here. Over the 50, a little bit more, and it's there. Head and shoulders would be invalidated. Looking at Goog, same thing. It's over the 50 MA, right on the downtrend. Only needs a whisker more to break bullish. Looking at Tesla. Tesla here again, we can note that there is a funnel lower, a little whisker more. It's ready to go. It can reclaim this gap at roughly 950. It's time go up. And what else have we got? NVIDIA. So NVIDIA here, right? Boom. It's ready to go up. It's really close too. Back over 270. I think it's probably going to try to go back to all-time highs. Even Facebook is back above its green line here. So again, looking back to previous tops, it's finding a bottom. It's engulfed the entire previous candle. There is no wicks on here. Wow. That's a nice candle. Let's move forward to the S&P 500. Looking here at our quarterly chart, which we talked about before, everything tells me that if this holds, we're going up. Looking forward to our monthly chart. Here we can note that again, briefly mentioned before, but for not very much upper wicks, which means dip buying 4 months in a row. So if they've been buying for 4 months in a row and they want it to go up now, we should see either a higher high printed on this month, back above 458.12, or an inside bar, which opens up into April and prints a higher high, which will give us a higher high and a higher low. As of right now, we got high, lower, low, higher, low, lower, low. Sorry, low, lower, low, higher, low, which means to break the pattern, we need one more candle. Looking at our weekly chart for evidence, we stopped going down, getting back above 454.05, invalidates the head and shoulders, and we're likely going back to all-time highs. Looking on the daily, 3 important for the chart to rally. So what we can note is that we stopped going down, we started going up, and we're battling for the last MA here at 446 for the 200 DMA. There we go. And then looking on the hourly, it's just rocking an uptrend here. So we got an uptrend forming here ever since Jerome Powell spoke, testing the lower uptrend, bouncing off this one here, and only up since then. So if this holds, we should be above 450 by Tuesday close. That's the target and number for us to look for. All right. I think that is for the video. And let me just get back down to the bottom here. And what I want to do now is just talk briefly about, if you're still looking for more content to watch, there should be a video that queues up here in a moment, which will be for my Is the Stock Market Crash Canceled for 2022? And in closing, this is a very long video. If you have any questions, please make sure to drop a comment, smash a thumbs up, and I'll be happy to answer. And if this reversal is really going to happen and we're going to go into a new bull market, this isn't a very exciting time. We've literally been working on building out a product for the last 2 years, an edge if this really happens. We have a lot of extra clues which tell us that the market could go higher. If you want to learn more, click on the link in the description, check out blazecapital.com, and we look forward to seeing you. Otherwise, thank you for watching, and we look forward to seeing you on the next one. Thanks again.